Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing VICI property stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. VICI Properties is a REIT that specializes in casinos. It was formed as part of the Chapter 11 bankruptcy reorganization of Caesars Entertainment. After filing bankruptcy in January 2015, Caesars proposed splitting into two companies, a REIT, which would own the company's casinos, and an operating company, which would manage them. The plan was designed to maximize value for Caesars creditors by taking advantage of favorable tax treatment for REITs. The spin-off of VICI was completed on October 6, 2017, the day that Caesars emerged from bankruptcy. The REIT we're looking at has 43 properties in 15 states, 3.8 million square feet of casino space, and 58,000 hotel rooms. It has collected 100% of the rent from its tenants. A REIT is only as good as its tenants. This company has some of the best in the industry. It is partnered with Caesars, Penn National Gaming, Hard Rock, Century Casinos, Jack Entertainment, and Chelsea Piers. Lots of well-established, reputable brands. It is not solely concentrated in Las Vegas. Only 45% of its properties are in Las Vegas. In the event that Las Vegas struggles attracting tourists, then VICI will have money coming in from other parts of the US. Here is a visual of the cap rates for each property. The cap rate is a total return on a real estate investment. The big properties are Bellagio and the Venetian. Both of those have a cap rate of about 6%. The higher the cap rate, the higher the return. But if the cap rate is over 7%, that may be a really risky investment. If it's below 4%, it may not be worth investing in due to the low returns. 4% to 7% is a sweet spot for cap rates. Some investors feel the higher the institutional ownership, the better, since institutions can buy lots of stock at a time, which drives up the stock price. Also, institutions have teams of analysts that research stocks before the company invests in them. So lots of small investors buy the stock when an institution does, because they like to have their interests aligned with a multi-billion-dollar institution. VICI's institutional ownership has grown from 22% to 67%. In 2018, MGM Growth Properties offered to acquire VICI for $6 billion, but VICI's board rejected the offer. Currently, VICI's market cap is over $17 billion, so that was a good decision to reject MGM's offer. This company is headquartered in New York City and was founded in 2017. It can be found on the New York Stock Exchange and Deutsche Börse. Let's get started with the model. This is a large cap company, $17 billion market cap. They're trading at $28 a share, and they have 629 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow grows every year from $500 million to $945 million. Net income is the profit or loss on the income statement. It's revenue minus expenses, and that nearly doubles from $530 million to over $1 billion. Revenue is the sales for the company, and that goes from $900 million to $1.5 billion. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. And below that is their gross profit, which went from $800 million to $1.5 billion. Below that is their operating expenses, and these are all the expenses that are not directly tied to generating the revenue. And below that is their operating income, which also peaked in the trailing 12 months. They do have a lot of debt on their balance sheet, so they paid $400 million of interest on their debt in the trailing 12 months. And the bottom line of the income statement is their net income, which doubled from 2018 to the trailing 12 months. This is the company's income statement from their quarterly report. This shows us the first 9 months of 2020 versus the first 9 months of 2021, and the third quarter of 2020 versus the third quarter of 2021. A bulk of their revenue comes from financing leases. The idea of a financing lease is the company financing the property will own it at the end of the lease, like financing a car. They didn't have any operating leases in 2021. They had a little bit in 2020. They also provide loans to their lessees to help them fund CapEx and working capital. They collected $70 million of interest on those loans. And some of their properties have golf courses. They collected $6.5 million of revenue from those golf courses. So their total revenue went from $339 million to $375 million. Below that is their expenses. General and administrative, which is mainly payroll, was $8.4 million. Depreciation, other expenses of $6.9 million. The expenses to maintain the golf courses is $5.1 million. Allowance for credit losses are the rent payments the company expects not to receive in the future. I'll talk more about this later. That went down a lot from $177 million to $9 million because in 2020 they expected a lot of losses due to COVID. So their expenses went down a ton from $200 million to $30 million. They paid a lot of interest on their debt in the third quarter, $165 million compared to $77 million in the same time frame last year. And the reason their net income was so much higher in the third quarter of 2020 was this $333 million gain. The company modified a bunch of their lease agreements, so they passed through a gain onto the income statement. The income statement is not a good tool to use when looking at a REIT. The statement of cash flows is much better. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash a company generates from its operational business. So you can see that cash flow goes up every year. They don't spend too much on CapEx. $11 million was the most. Operating cash flow minus CapEx gives you your free cash flow. So they have lots of free cash flow remaining. About 90% of the cash flow is paid out as a dividend. So that means there's little money left over for VICI to grow the business. That's why they have to add a lot of stock and debt. They added $2 billion of stock in 2018, $1.2 billion, $1.5 billion, and $2.4 billion. When a company adds common stock, it dilutes the current shareholders and makes your shares less valuable. You can see in the investing cash flow section, they bought a lot of properties. They had $4.5 billion of cash outflow that year. So that's why they had to add so much debt and stock to fund their growth. This is their operating cash flow section from their quarterly report. This shows us the first 9 months of 2020 versus the first 9 months of 2021. And the way you calculate operating cash flow, you start with your net income, then you have to add or subtract the non-cash items on the income statement, then adjust for changes in working capital. So we start with the net income of $739 million. It looks like they passed through a $90 million gain on the income statement from their lease financing adjustments. But this is a non-cash item, so we subtract it out here on the statement of cash flows. They paid $7 million in stock-based compensation. They had $2.3 million of depreciation, and they had $51 million of amortization of debt issuance costs. Amortization of debt issuance costs. So when a company issues debt, when they sell bonds, there's a lot of expenses involved. They have to pay a registration fee, legal fees, sometimes printing costs, underwriting costs, and there could be a lot of other expenses. So these expenses are capitalized. They're carried on their balance sheet and amortized over the life of the bond. That's the purpose of accrual accounting, is to smooth out your earnings and expenses. Because if you issued $100 million of bonds and the expenses were $5 million, it would not make sense to report the entire $5 million, because if you reported the entire $5 million onto the income statement, it would bring down your net income a lot that first year. But if these were 10-year bonds, that $5 million should be spread across 10 years. Last year, allowance for credit losses was big, $261 million. Because of COVID, they passed through a large loss onto the income statement. Allowance for credit losses is not a cash item, so we have to reverse that out here on the statement of cash flows. The allowance for credit losses is an estimate of the rent they don't expect to receive from their tenants. Say you had a business that rented out properties, and you had 100 properties, and each year you expected to receive $1 million of rent payments from all your properties. And if you ask someone to invest in your company, providing them that information, they may expect $1 million in rent payments per year. But what if you only received $900,000 in rent payments a year? Then the person investing in the company may feel they were tricked because they invested in a company thinking there was $1 million of cash flow when there was actually $900,000. So to provide accurate information, you have to pass through an allowance for doubtful accounts because you can't expect to receive 100% of your payment. Unless historically you did receive 100% and it's fine. But generally, most creditors don't receive 100% of their debt payments. If a bank gives out a bunch of loans, they can't expect everybody to pay. Some people just don't have the money. They file bankruptcy, they run into hard times. That's what allowance for credit losses is. This allows companies to take anticipated losses into consideration in its financial statements to limit overstatement of potential income. So a company has to try to predict their future losses before they occur. So they may actually understate income if they projected losses higher than what actually occurred. It looks like they paid off some debt early, so they passed through an expense of $15 million on the extinguishment of debt, and they had a cash outflow of $93 million on deferred revenue. Deferred revenue is when you receive payment for product or service before it's delivered. So they received payments from customers up front. Maybe they paid for all 12 months of their rent up front for the year, but they can't book that revenue until the month occurred. So deferred revenue is really a timing thing. Even though they reported $739 million of net income, they actually generated $610 million of cash flow. Let's look at their cash flow from investing and cash flow from financing sections. This is the first 9 months of 2020 versus the first 9 months of 2021. In the investing section, they had a cash outflow of $6 million on financing receivables. Last year, they had a cash outflow of $2.7 billion. So it looks like they provided a bunch of leases last year, and then $1.4 billion in sales type and direct financing leases. Last year, they provided loans of over $500 million. These aren't loans to lease real estate. These are loans so its operators can either grow their business or pay their current bills. They had a cash inflow of $30 million on the repayment of some of those loans. When one of their tenants pays the principal on a loan, that goes into the investing section. When they pay the interest, that goes into the operations section. So in their investing section, they had a cash inflow of $20 million. Last year, they had a cash outflow of $4.5 billion. You can see they raised a lot of stock. They raised $2.4 billion this year, $1.5 billion last year. They also raised $2.5 billion from senior unsecured notes. They paid back $2.1 billion on a term facility. They paid $532 million of dividends. Last year was $435 million. In their financing section, they had a cash outflow of $277 million. Last year was a cash inflow of $3 billion. This is the equity section on their 9/30 balance sheet. They have $12 billion of equity. They raised $11.8 billion from selling their business, and they profited $300 million from running their business. That's pretty good because a lot of REITs have negative retained earnings. Theirs is positive. Let's look at the capital structure. $12 billion of equity, $5 billion of debt. They're 71% equity, 29% debt. And I gave them the highest whack on Finbox, 7.8%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows past year 4, that's $36 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $31 billion. We divide that by 629 million shares. And we get a calculated stock price of $50. They're trading at $28, so they're trading at a 44% discount. It's a buy according to the model. Their revenue is projected to increase 31% a year. So I grew their revenue 31% a year for the next few years. That's how I got their future revenue estimates. To get their future free cash flow, I need to see what percent of their revenue they convert to free cash flow. So I summed up these 4 free cash flow numbers. I divided by these 4 revenue numbers. And that comes out to 66%. So I multiplied their future revenue estimates by 66%. That's how I got their future free cash flows. Simply Wall Street is on another planet. Their valuation is 144. They're saying the stock is 81% undervalued. 7 analysts priced this stock and the average price target is $36. This is where the stock has been trading the last 2 years. The stock dropped a lot during COVID, more than the average stock. But it's done really well since then. It's pretty much only gone up. It has regressed a little bit in the past few weeks. There was a lot of selling activity right here, right before the dividend. If there's a red bar down here, that means the sell orders are greater than the buy orders, and the stock goes down. If there's a green bar, that means the buy orders are greater than the sell orders, and the stock goes up. Their beta is pretty close to 1, so the stock moves with the market. It's gone up 7.5% in the past 52 weeks, while the S&P is up 25%. The 52-week low was 25, the high was 33. And the stock is trading below its 50-day and 200-day moving average. About 6 million shares of stock are traded each day. Of the 629 million shares outstanding, 627 million are on float. It has a really high short percentage. Almost 16% of the shares on float are shorted. They raise their dividend every year. It's up to 36 cents a share. They pay a 5.2% dividend yield, which is 88% of their net income, 96% of their free cash flow. And their dividend is much higher than their industry. Their industry pays 2.8%, they have 5.2%. Their employee count was around 140 for a few years, but now it's 130. If you invested $10,000 into this company when it started trading and you reinvested the dividends, you'd have $17,000 today. That's a 14% annual return. There's no insider selling, there's just buying. The president bought 8,800 shares. Their general counsel bought 4,400 shares last month and another 3,400. One of their directors bought about 21,000 shares. The biggest shareholder is Capital Research at 16%. They have 100 million shares valued at $2.8 billion. Next is Vanguard, then BlackRock, Cohen & Steers, and Wellington. Let's look at their financial ratios. Their PE is 17. Their price of sales is a bit high at 12. They have a really good price to book at 1.4. Their ROIC is 7%. They can cover their interest payments almost 4 times. Their ROE is 8.5%, and they have a really high current ratio and quick ratio. They seem to be well capitalized. They generated $945 million of free cash flow in the trailing 12 months. They have $3.5 billion of working capital, and they paid out $900 million of dividend payments, so they have $3.5 billion of funding. The best way to look at ratios is to compare them to companies in the same industry. I've done videos of 3 other companies in the same industry as VICI, and if VICI has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. When you look at a REIT, you should look at funds from operations instead of net income. This ratio is price of stock over funds from operations per share, and the lower the better, and they have the highest of the 4 companies. They're better than average in PE, worse than average in price of sales, and they're better in every other category after that. They're the biggest company on this list, and they pay a good dividend at 5.2%. WP Carey pays a little higher. So to summarize, I have them trading at a 44% discount. REITs are usually fairly safe investments. You get a high dividend. Since they pay less taxes, that means more money flows to the bottom line, which means a higher dividend for the investor. And their revenue grows a lot each year, so does their free cash flow. So it seems like a pretty stable investment from what I see. I ranked their free cash flows 8 out of 10, their revenue 8 out of 10, and their ratio is 5 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.